I would like to express my concerns based on three hidden risks associated with climate change. The first relates to stranded assets of insurers investing in fossil fuels. The second is a more insidious risk related to climate change. This risk is associated with the long-term liabilities associated with property, life, and health lines of business. And I realize that a number of intelligent people and experts don't see a long-term liability, but they're missing one important part, is that primary insurers are not able to withdraw or reprice entire books of business. Following hurricanes Katrina, Rita, and Wilma, new hurricane models were developed in Florida, and they attempted to get the recommended rate approvals for that. They were not allowed to, and so many insurers began to withdraw from that market. 10 years later, that about 40% of the underperforming business is still on the books of those insurers. And this could play out in several other states that are exposed to climate risk. For a reinsurer, the value of reinsurance with their customers is a long-term business. The reason why this is so important is because, according to my count, 156 of your reinsurance customers have filed climate change disclosures. And these customers are looking for long-term interest being protected by their reinsurer. And if not, there's a potential for a relationship default risk that could occur if they perceive your reinsurance as just being one-year contracts that can be repriced or withdrawn, and you enter into that world of the expanding market competition of alternative reinsurance, which just last year was $72 billion, and earlier this quarter we set a record of $2.2 billion in cat bonds.
Thank you. I would point out that we have not been asked ever, to my knowledge, to write long-term contracts. Our primary insurers know that we look at it 1 year at a time, and we will not write business that we think has a major negative probability, and they don't expect us to. It's way less a relational business than in the past. It's much more a transactional business, but we will not write. If we lose a customer because they want us to do something stupid, we lose the customer. There's not in our business, I'm not speaking for other reinsurers, but in our business, and I believe with most other reinsurers, they are not going to do something that they think is terribly disadvantageous to them just to maintain a relationship. That's not really a relationship, and be a subsidy. So that does not strike me, frankly, as a factor at all of any negative consequence at Berkshire. We, in terms of what happened after Katrina, rates went up, and actually the hurricane experience in Florida has been better than any period since before 1850 that we have any records on. That's been a surprise to us, incidentally, but we have not written catastrophe business in Florida during that period because we didn't think the rates were adequate. They were adequate, we just were wrong about it. And incidentally, that is not, the fact that we walked away from cat business in Florida that we thought was mispriced does not hurt us in the business. It's much more of a transactional business, and there may have been a time when relationships were very big in reinsurance, but with so many entrants in it is very much a transactional business, and no one expects you to do something that's very stupid. If they do that, that's the wrong kind of a relationship.